When you had a job, taxes were simple. Your employer took them out before your paycheck ever hit your account. You filed once a year. You moved on. But the moment you retire, there's no welcome letter, no checklist in the mail, no phone call from Social Security telling you what changes. The IRS doesn't send a guide. Your former employer is done with you. And most financial advisors will not walk you through the 10 things the federal government now expects from you. I've watched retirees lose $4, $5, sometimes $10,000 a year, every year, for the rest of their lives. Not because they did anything wrong, because nobody told them what the IRS quietly expects. If you miss just one of these, a single deadline, a single form, the penalty can wipe out an entire year of investment returns. The IRS does not call to remind you. They send a letter, and the letter is always more expensive than the original mistake. This is for informational purposes only, and not financial, tax, or legal advice. Please consult a qualified professional for your specific situation. My name is Robert, your guide to retirement tax strategies the IRS doesn't advertise. If you find this helpful, hit subscribe. Robert covers the retirement tax topics your advisor might not be telling you about. New videos every 2 days. And do me one quick favor while you're here. Drop a comment below with the state you're watching from. Every state taxes retirees differently. Social Security, pensions, IRA withdrawals, and the states most of you mention become the next videos I make. So tell me where you are, and I'll tailor what's coming next to where retirees actually live. I'm going to walk you through the 10 things every retiree is now responsible for in the eyes of the IRS. I'm going to explain why nobody hands you this list, and what it costs the people who never find it. And I am going to show you how to fix every one of these in an afternoon. 10 things. All of them matter. And in my experience, most retirees miss all 10. The first one is the one that catches the most people. When you retire, there is no employer filing forms on your behalf. You are now the one filing. And many retirees assume that because they no longer earn a paycheck, they no longer have to file a return at all. That is not how the IRS sees it. If you have Social Security, a pension, an IRA distribution, dividends, capital gains, or interest, the IRS expects a 1040. Even if you owe nothing, even if you get money back. The threshold for filing in retirement is much lower than people realize. For a single filer over 65 in 2026, you must file if your gross income is over about $16,500. For a married couple both over 65, the number is around $32,000. Once a single dividend check or one IRA withdrawal pushes you over that line, you are required to file. And here's the part nobody tells you. If you do not file, the IRS can prepare a return for you. They call it a substitute for return. They build it without your deductions, without your basis, without any of the tax breaks you actually qualify for. They will calculate the worst-case version of your year. Every single sale on your brokerage statement treated as pure profit. Every IRA distribution taxed at the highest possible rate. And then they will send you the bill, plus penalties, plus interest. I have seen retirees receive substitute for return notices for $15,000, $20,000 on years they should have actually gotten a refund. Always file, every single year. The second is the most expensive mistake on this entire list. Once you turn 73, or 75 depending on your birth year, the IRS requires you to start pulling money out of your traditional IRA, your 401k, your 403b, and most pre-tax retirement accounts. This is called a required minimum distribution, and the IRS does not remind you. Your account custodian may send a letter. They may not. The amount changes every year based on your account balance and a life expectancy table. If you miss it, even by accident, the penalty is 25% of the amount you should have withdrawn. 25%. On a $50,000 RMD, that is $12,500 in penalties. For one missed deadline. Here is what most retirees miss. Your first RMD has a special grace period. You can delay it until April 1st of the year after you turn 73. Sounds great. But if you do that, you owe 2 RMDs in the same calendar year. 2 distributions, stacked into 1 year of income. That can push you into a higher tax bracket, trigger more Social Security taxation, and spike your Medicare premiums 2 years later through something called IRMAA. One bad timing decision can cost you for years. The deadline is December 31st every year. Calendar it. Set 3 reminders. The IRS does not care that nobody told you. And if you have multiple traditional IRAs, you can pull the total RMD from any one of them. But 401k RMDs must come from each plan separately. Get that wrong and the 25% penalty applies to whatever you missed. The third one blindsides almost every newly retired person. When you were working, your employer withheld taxes from every paycheck. The IRS got paid as you earned. In retirement, that disappears. Social Security has minimal automatic withholding. Pensions sometimes have it. IRA distributions usually don't unless you ask. Which means, at the end of the year, you owe a large lump sum the IRS never received. And if you owe more than $1,000 at filing time, the IRS adds an underpayment penalty. The fix is quarterly estimated taxes. 4 payments a year: April 15th, June 15th, September 15th, and January 15th. Or, and this is the move most retirees miss entirely, you can have taxes withheld directly from your IRA distributions and Social Security checks. Form W-4V for Social Security. Pick 7, 10, 12, or 22%. Form W-4R for IRA distributions. Defaults to 10% unless you say otherwise. Set it once. Done forever. And here is the trick the IRS will never tell you. Withholding from an IRA distribution counts as if it was paid evenly across all 4 quarters, even if you do it in December. Forgot to make estimated payments all year? Pull a December IRA distribution with heavy withholding. The IRS treats you as if you paid on time. That single move saves retirees thousands in penalties. The fourth thing the IRS expects is total cooperation on every 1099 form you receive in January. And in retirement, you will receive a lot of them. There's the SSA-1099 for Social Security. There's the 1099-R for every IRA, 401k, or pension distribution. There's the 1099-INT for bank interest, the 1099-DIV for dividends, the 1099-B for any stock or fund you sold, the 1099-NEC if you did any consulting, the 1099-MISC for miscellaneous income. Every single one of those forms is also sent to the IRS, so if it shows up in your mailbox, it has already shown up in their database. If you forget to report one, even a small dividend, their computer will flag the mismatch. You will get a CP 2000 notice. They will recalculate your tax with the missing income. They will add penalties and interest. The fix is simple. Wait until February to file. Every form should be in by the end of January. Match everyone to your return, line by line. And here is what really catches people. Sometimes a 1099 arrives in March or April. Corrected forms with the word amended stamped at the top. If you already filed, you may need to amend your return with a 104-0-X. Yes, it is annoying. But ignoring an amended 1099 is how $500 mistakes turn into $5,000 IRS letters with penalties and interest tacked on top. The fifth thing the IRS expects, and almost no retiree has done, is to know the cost basis of every stock, fund, and security you own. Your cost basis is what you originally paid for an investment. When you sell, the IRS taxes you on the difference between the sale price and your basis. For investments bought after 2011, your broker is required to track basis automatically. For anything you bought before 2011, old shares, inherited stock, dividend reinvestment plans, you are responsible. If you cannot prove your basis, the IRS treats your basis as zero, which means you pay tax on the full sale price. On stock you might have held for 30 years. The difference can be tens of thousands of dollars on a single transaction. Pull your old statements. Talk to your broker. Document your basis now, before you need it. And if you inherited stock, the basis was reset at the date of death. That is a step up in basis, and it is one of the largest tax breaks in the entire code. Use it. A quick example. You inherit stock your parent bought for $2 a share. By the date of death, it is worth $80. Your basis is now 80, not 2. Sell at 85, you owe tax on $5 per share, not 83. Document every inherited holding the day you receive it. The sixth one trips up retirees who think Social Security is tax-free. It is not. Up to 85% of your Social Security benefits can be taxable at the federal level, depending on your other income. The IRS uses something called combined income. It is your adjusted gross income, plus any tax-free interest, plus half of your Social Security benefits. If that combined number is over $32,000 for a married couple, or $25,000 for a single filer, part of your Social Security becomes taxable. Over $44,000 married, or $34,000 single, and up to 85% is taxable. That means a Roth conversion, a large IRA withdrawal, or even a one-time capital gain can pull more of your Social Security into the taxable bucket. The IRS expects you to do that math correctly. The fix is to plan your withdrawals across the calendar year, not all in December. And the cruel part, those thresholds have not been adjusted for inflation since 1983. They have never moved. Every year more retirees cross them simply because the world got more expensive. Run a tax projection in October, before that final IRA distribution. A single $1,000 over the line can cost hundreds in extra tax. The seventh thing the IRS expects is for you to actually claim the deductions you qualify for. Once you turn 65, the standard deduction goes up. For 2026, single filers get an additional $1,500 roughly. Married couples filing jointly get an additional $1,200 per spouse over 65. If both spouses are 65 or older, and one is blind, you can stack additional amounts on top. Most tax software catches this automatically. Most paper filers miss it entirely. Read your 1040 carefully. The age boxes are on the front page. Check them. For a married couple where both spouses are over 65, that bonus alone can shield around $3,000 of income from federal tax, every single year. Over a 20-year retirement, that is $60,000 of income that never gets taxed. Free money, but only if you check the box. The eighth, and this catches even sophisticated retirees, is that every Roth conversion is a taxable event in the year you convert, not when you withdraw, not when you turn 73, the year you move the money. If you convert $50,000 from your traditional IRA to a Roth in 2026, that $50,000 is added to your 2026 income. You will get a 1099-R showing the distribution. You will report it on your 1040. You will pay tax at your ordinary income rate. The IRS expects you to plan for that bill, not be surprised by it. And there is a 5-year rule most people never hear about. Each Roth conversion has its own 5-year clock. If you withdraw converted money before that clock runs out, and you are under 59.5, you owe a 10% penalty on top. The Roth account itself may be older than 5 years, but each conversion starts a new timer. Track the year of every conversion. Write it down. The ninth thing the IRS expects, well, technically your state expects this one, but the federal return triggers it. Most states require their own return based on your federal numbers. Some states tax Social Security. Most do not. Some states tax pensions. Some do not. Some states tax IRA distributions. A few exempt them. If you moved in retirement, or split time between 2 states, you may owe a partial year return in each. The IRS shares data with state tax authorities. Skipping a state return after filing federal is the fastest way to draw an audit. And if you snowbird between 2 states, winter in Florida, summer in New York, be very careful which one you call your domicile. High-tax states like New York and California are aggressive. They will audit you. They want phone records, doctor visits, gym memberships, library cards. Pick one state. Establish residency cleanly. Keep records. Otherwise, you may end up paying tax in both, on the same income. The 10th and final thing the IRS expects is for you to keep your withholding current. Form W-4, V controls, Social Security. Form W-4R controls IRA distributions. Form W-4P controls pensions. As your income shifts year to year, RMDs grow, conversions stop, part-time work ends. Your withholding should shift too. Review every January. Adjust before the year runs away from you. So here are all 10, in order. 1. File a return every year, even with no wages. 2. Take your RMDs by December 31st. 3. Pay quarterly estimated taxes, or set up withholding. 4. Report every single 1099 you receive. 5. Track your cost basis before you need it. 6. Report the taxable portion of Social Security. 7. Claim the higher standard deduction at 65. 8. Report Roth conversions in the year you convert. 9. File your state return alongside your federal. 10. Update your withholding forms every January. 10 things. All of them matter. And almost nobody tells you them all in one place. If this helped you, hit the like button. It takes 2 seconds, and it helps more retirees find this information. Subscribe if you haven't already. And if you know someone who's about to retire, or just retired, send them this video. Today, not tomorrow. Today. Drop a comment below. What's your biggest question about retirement taxes? I read every single one, and the most common situations become future videos.